a rental agreement typically, as well as a deposit from the person that's going to rent that house, to then be able to offset that payment and not hit them for that payment when they go and they buy the new place. You don't have to do that if the client makes enough money to float both of the payments. But if they don't, then that's the way around that. You keep that. If someone asks you, hey, can we rent this place out? How does that work? You go, yeah, you can rent it out. And then what you typically get to use is 75% of that rental agreement to offset the payment on that property. The payment includes not only the mortgage, but the property taxes, the home insurance, the HOA payment, any sort of other obligation that's tied to the house. And as long as they've saved 5%, somewhere between 5 and 10% for this new purchase, they can do that. They don't need to have 20% to go and buy the new property. So it works really well, again, for someone that potentially wants to retain their current property, and it's going to be a good rental. They're positive cash flow on the rental. It doesn't get you 2 transactions, unfortunately, but there's a lot of people that like to try to keep their real estate, and I'm a big proponent of that. So keep that in mind. And then let's say you rented it for a year, you rented it for 6 months. The lease agreement would need to be for a year, but no one's saying the client can't change their mind. No one's knocking on their door, just so you're aware. And then they come back and they can potentially market and sell the property after the purchase transaction has closed on the up leg. So one other really cool thing that I have, that's a bullet point right there, it says recast payment. What that would be involving is this same scenario, and then you've come back and you've sold the property that you turned into a rental, and the client made $100,000, $200,000 on that sale. And they ultimately, when they came to you, they wanted to be able to buy the house with the proceeds and the equity of the condo they had, but they just can't because timing doesn't work. What you then can do is, after you've purchased that new property, you can come back and you can take those proceeds and you can apply them to the loan that you got and recalibrate the payment over the next 29 and a half years or 29.3 years. It keeps the same rate. It costs like $100 to do. It's not a full refinance transaction at all. It's just, hey, we got all this money, we want to apply it to the principal of this loan, and we want a new payment based on that lower principal balance for the remaining years and months that we have. And it's really cool option, again, to avoid a full refi. If they've locked in a super good rate, the 5% down, the 10% down, the 20% down loans that we're doing on 30-year fixed terms are all pretty similar in rate. The only difference between them all is the mortgage insurance that's covering, the bank for not having enough equity at the time of purchase. So even, today, for instance, a 20% down loan is 2.75. A 5% down loan would be 2.875. So this recast option is really cool, and it definitely gets used more often than you guys would think. I do it quite a bit when we're navigating these contingent purchases. Any questions at all? No. Okay. Cash out refi is the solution. This is the one where you have a planner, you have a client that knows in 4-6 months that they want to buy a new house. They have a ton of equity in their current house, and they potentially want to keep that house to rent it out, and they want to be able to use the equity to then go and buy a new place. They haven't been able to save the hundreds of thousands of dollars they need for the down payment. It's tied up in their house, but they know that they can tap into their equity and create the account or create the amount of funds needed through a cash out refinance. There's 2 ways to take cash out of your house. One is a cash out refi, which is similar to just a refinance of changing the rate, except let's say you have a loan for $100,000, you do a new loan for $200,000. When the transaction closes, you end up with $100,000 in your pocket. They just wire it over to you, escrow does, and they have a new loan for the next 30 years, starting on that $200,000. And you typically can tell them you're going to use it for a new purchase. It's up. I'll go over that with the client in particular, but if you just take the cash out, you have it sitting there. The banks like to see it there for 2 months. It's not absolutely necessary though. I've done cash out refinances as contingent purchases where you're buying the house and the contract is subject to the cash out refi on their current property. So the money doesn't necessarily have to sit in season like some people would think. The other way to take cash out of your house is called a home equity line of credit. And these are the easiest way to think about a home equity line of credit is like a credit card on your house. It's a fluctuating rate. It only is a payment that's forced when you borrow the money on it. You can pay it back down and reborrow from it for typically 10 years. After those 10 years, then the home equity line of credit would turn into a fixed loan, or excuse me, an amortizing loan, meaning you would start paying back both the principal and the interest, but the rate never fixes in. So what's better? It really is scenario dependent. Home equity lines of credit are really, really good things for any of your clients to have on their house. They're a policy for when something happens to their family and they need quick money. So I always recommend people have a home equity line of credit on their house, just because it's such quick access to money if you come in a pinch. But if you're really risk averse and you don't like the nature of home equity lines of credit because the interest rates can balloon to 18%, and the payments are the minimum mandatory payments are only paying the interest off, then you would suggest, hey, let's just do a cash out refi at 3% for 30-year fixed on your house, and you won't ever have to worry. It's a nice, smooth, simple payment. So it really is scenario dependent on what's better. And yeah, I don't know which one I would personally. I would probably just do a cash out refi if I was going to keep my house as a rental. I would do a HELOC if I was then going to go back and sell my house after I bought the new place. Less transaction cost for a HELOC, and the payments are lower to float for the couple of months or 6 or 8 months that it would take to then come back and sell your house. Can this be done simultaneously? Yeah, as I said, yes, they can definitely be done simultaneously. You just need to get a seller to bite off on the refinance transaction. And that's where, essentially my pre-approval would come in and say, hey, we have this loan good to go. And, the cash should be here in 20 days and definitely in time for our 30-day transaction. And, just, they got to take some faith. They got a little leap of faith with us, but I can definitely wordsmith and smooth it over with the sellers usually in that situation. Okay, I think that's all for this slide. Recasting I talked about, but again, definitely something that hasn't always been around and is a really good tool in your toolbox to be able to suggest in this situation, because someone really wants that lower payment. They don't really want to bite off on a $700,000 loan, but they have to be able to buy a new house first. Hey, come back, and when you make 300 grand on your house, you can take that 300 grand and you can apply it to the principal balance of your mortgage. $300,000 today is roughly $1,500 a month, somewhere between $12 and $1,500 a month in mortgage payment that would be reduced from your current payment that you signed up for. So, hey, you want that lower payment, but we got to buy this house first. Let's do this bigger loan, come back, sell your house, take the money once you sold it, apply it to the loan. That's exactly what this is. Okay. Let me see. Yeah, it's only about 150 bucks, small processing fee. It's only, somewhere between 150, $200 to do that, just to do the paperwork. Okay. A few housekeeping items, stuff to keep in mind. This is more for me than you guys. But if the client is doing 2 properties, they need to have some money in the bank after or when they're purchasing that second property, if they're keeping the previous property, called reserves. Reserves are 1 month of reserves would be the sum of 1 month of your principal, interest, taxes, insurance, HOA payment. And typically in these cases, they like somewhere between 2 and 6 months of reserves for the property that you're keeping. And because you're going to turn into a rental, they don't know how quickly you're going to be able to rent it out. They like to see that you have some money to cover the payment for a few months, to give them the blessing that, you have the wherewithal to do 2 houses. So, if someone's really scraping, only has that 5% down, then we need to definitely keep that in mind. Reserves can come out of 401ks. They can come out of investment accounts. It doesn't have to be liquid. So definitely a good thought there. Some banks require there to be a certain amount of equity in the departing property to be able to use rental income. So you can't have 95% or 90% of the property that you're leaving tied up. This is, again, that rule is more so for bigger purchases in the sub $800,000 loan range. It doesn't matter how much equity you have. You can always use the lease agreement to offset the payment. If you're starting to do the the $2 million purchases, and you're trying to use a rental agreement, you do have to have 25% equity in that property that you're leaving to be able to use the rents. So important. A lot of people have that amount of equity at this point after this real estate market for the last year and a half. So not much of a fear or a worry, but something to keep in mind. Rates. What are rates? Any COVID lending updates? Rates are still super low. The Fed came out on Wednesday and said that they were going to raise rates a little quicker than we initially thought coming out of COVID. They said they're going to potentially bump them up at the end of 2023 instead of 2024. So what happened? Mortgage rates on Wednesday went a little haywire. They've since today went right back down to where they were before the Fed talked. So nothing really happened. 2.75 on the conforming loans, 2.875 on the high balance conforming loans. The loan amounts there for you in the slide. Jumbo loans are over 3. They're like right around 3.25, 3 3.125 to 3.25. And FHA loans, 15-year loans are 2.25. FHA loans are definitely pretty low, 2.25, 2.5. The VA loans are best loan in the business, 2.25% there for you. Self-employed clients still definitely need to do profit and loss statements. They need to provide business bank statements to get loans these days. So if you have self-employed clients, we're still scrubbing them pretty clean. There isn't just we'll go off of 2019 tax returns if you haven't filed 2020 like they used to. They take a look at a P&L from 2020. They take a look at a P&L from 2021. They make sure that the money that you're claiming as income on 2021, each month for the last 3 months, roughly, if you had a P&L for the first 6 months of 2020, they'd like to see 1/6 of the amount that you're claiming as income go in each month. For real estate agents, for you guys, they know that your income comes in big chunks. They just would like to see that your trajectory is still very similar to back in 19 or in 2020 to give you the income off of your tax returns. For W-2 employees, the employment is checked right before we close. People aren't losing their jobs. They can't even get enough people to work right now. So that was definitely more important in the midst of the pandemic. It's not as big of an issue now, but they are looking for, large declines in income. Again, if your company hasn't gotten back on its feet coming out of the pandemic, there isn't any freebies and just, sorry, yeah, we know you're dealing with a pandemic, but here's your loan. That's not going on. Forbearance, if you were in forbearance and you want to do a new loan, you'd have to have made 3 payments out of forbearance to be able to do a new loan. That's even if you're going to buy a new house and your old loan was in forbearance. So keep that in mind. If you're not paying your old loan, they're not going to give you a new loan. Makes sense, right? That's all I got. Thank you for all of you who attended. My cell is here. My email is here. It is a link. I can share this PowerPoint with you if you'd like. My door is closed sometimes, but I'm always available. Just rattle it if you're down in Long Beach. And primary investment property, second home, residential loans, 1 to 4. That's our wheelhouse. We have contacts for other stuff, hard money and bank statement style weird loans, but really like to just, the sweet spot is the 1 to 4 and the residential. And
so
I don't have.
Maybe if anyone has a question, feel free to unmute yourself or put it in the chat. We have quite a few people on, so no questions? Okay. Anything else, Alex?
I can't think of it. I can't think of anything.
Okay. Well, it will we broadcast live on YouTube, but it will also be on our YouTube channel. So if anyone needs to go back and, want to take a second look at review any of your slides, then it will be there.
Yeah, that's great. Again, call me, reach out. I am here for you guys.
You do have one question here.
Oh.
Can you use a rental as an Airbnb in the rental agreement?
No, you can't. Great question. You cannot do Airbnb. To do Airbnb, you'd have to have 2 years of tax returns with Airbnb history. But the whole point of the bank, the whole thing that banks try to do, not only with income, with rental income, with everything, is to establish consistency. Okay, that's what they're trying to do. Hey, what did this person make last year? Can we assume that they're going to make this amount this year? Same thing with rentals. If you have Airbnb, there's no way for them to establish any sort of consistency. You could make $3,000 one month and then $0 the next. So they don't know how to offset the payment. So it has to be a year lease. Anytime you're doing the transition of a primary residence into a rental property, it has to be a year lease.
Okay. Okay, so thank you. All righty. Well, if there's not anything else, I guess that wraps it up. Thanks, Alex.
Thank you.
And we'll see you in Long Beach.
Yeah, please come and say hi, everyone. Okay. I'm here.
All righty. Thanks.
Ciao.